Hi guys, my name is Tinashe and welcome back to All Things Finance and Productivity. It is always such a pleasure to have you guys on board. I hope you're doing well this week. So let's just get to the video. Today what we're going to be talking about is putting all your money in the bank. I know as we're growing up at times, financial literacy is really limited. You have probably grown up with parents who are not as financially literate with reference to just teaching us how to do better with reference to finances. And then sadly, the education system might also be flawed in the sense that they also don't invest that time to teach us about money. The only time that you really learn about money is, say, when you're doing math, and we all know that many people do not like math. But within that math, it really is not, say, tailor-made to your personal finances and how you can do better. Taking it a step higher, at times now people who do accounting, those are the people who are, say, in business classes, those are the people who actually get an advantage with reference to how to do better with reference to taking care of money. But like I said, still, that personal finance aspect is really not included. So at times now, there you are, God has blessed you with a job, or now you're an entrepreneur, money is coming in, you don't really have the basics of, okay, so now how do I go about making sure that this money works for me? So what do? Start putting your money in the bank. There is nothing absolutely wrong with putting your money in the bank, but there are just a couple of things that you need to consider, right? Let me give you an example. I've been blessed with diversity with reference to my upbringing, etc., right? So I was blessed with upbringing in two cultures, that is the Kenyan culture and also the Zimbabwean culture, right? And I'll give you an example about putting your money in a bank. There was a time in Zimbabwe when things really went bad. And if you're watching this channel and you follow history and what has been happening within various countries, say in Africa, then you know that there was a time whereby in Zimbabwe there was hyperinflation. Like it was really bad. So there was a multi-currency regime. And people could use dollars, they could use rands, they could use pulas. The rand is for South Africa, the pula is for Botswana. So people would put that money in their accounts, right? So there you are, you have a bank account, you're thinking your money is well taken care of, and then all of a sudden, overnight, the government made a decision to convert all that money that was in a different currency into Zimbabwean dollars. And like I said, there was hyperinflation. So if you had, let's say, $100, when it was converted back into the Zimbabwean dollars, it really couldn't buy as much as it would have had it been $100. So you can see, right? Just given one good example, I'll give another Kenyan example. There was a bank run when it came to Chase Bank. Chase Bank didn't do so well. Obviously, when people start hearing that the bank is not doing so well, there's sort of like a bank run. What a bank run is if, say, I'm told that this particular bank is not doing so well and I've put money in there, then I will go to the bank and demand my money, right? The bank might not have all that money at one go. So now Tinashe goes there, another person goes there, many people go there and they're demanding for their money. So it becomes a bit tricky. Chase Bank, Imperial Bank, we all know what happened here in the Kenyan market. So what that teaches us is not to put all your eggs in one basket, right? So here you are thinking, okay, so what other baskets are there, right? Given all this context, you can already see that really you need to diversify where you put in your money, different vehicles, etc., but vehicles that also work for you. Fine, you're putting money in the bank right now, but what interest are you getting? At times, if it's a current account, you're not getting any interest at all, right? The other day I was asking Barclays what their savings account interest rate was, and imagine it was 2.5%. So you can imagine, I'm like, that is so low. That does not even cushion for your inflation, does it? And yet that is where you've put your savings. So those are just some of the things that this channel is for, so that we can grow together and we can work well together with reference to our finances. So anyway, what vehicles are there? So this video is just for education purpose. You definitely need to do your research, because remember, this is your money. So sit down, do your research, do what you need to do. Desktop research, go to these financial institutions so that you find out from them firsthand what they're saying before you put your money in there, right? Now, let's speak about the different financial vehicles. The first one is you put in your money in shares, right? Now, shares can be very tricky. Shares can be very, very tricky. We all know there's that term called high risk, high return. I feel like shares are up there with reference to the risk levels, right? So you need to just ascertain what your risk profile is. For someone who's a bit older, you might need your cash to be a bit more liquid, right? And buying shares, that is a long-term investment, unless if you're someone who's speculating. What we mean by speculating is you are very in tune with the market, you know what is happening. So yeah, you're an active investor, and you're putting your money here so that it can make gain, and then you quickly remove or you put it in something else. So that is what a speculator is. For some of us, in fact for most of us, we really are not that financial swarthy. So we're more of passive investors. So you see, that's why now at times you need to see your risk appetite. Be very honest with yourself as to what is your risk appetite right now, so that you can make that necessary step. So what I did on Friday, I just looked at the Nairobi Stock Exchange to look at the prices for banks, right? The share price for bank. So what we have here is NCBA. So if you're watching my video and you're not in the Kenyan market, I'm in the Kenyan market, so I'll have a bit more context to the Kenyan side of things, right? So NCBA, they have a share price of 25 shillings 5 cents. Equity Bank has a share price of 52.50 shillings. ABSA 12 shillings. KCB 46 shillings. Stanbic 91 shillings 75 cents. So you see now, those are the prices per share. But remember, if you are going to go into stocks in the Kenyan market, you only buy shares in batches of 100. So you cannot say, I'm going to buy one share. So you need to be very cognizant of that fact. And I think maybe we'll do a video with time about shares and how to just go about them within this particular market, because now that's the market that I'm well versed in. So as you can see there, that is one avenue that you can put your money in, just to have a diversified portfolio and not to put all your money in the bank. The second bit where you can put your shares in is a unit trust. So a unit trust basically just pulls resources together from various individuals, and then they invest in various things. But you see, with the unit trust, you already know the stuff they're going to be investing in, because there are some goals and there's some objectives. They cannot have a mandate and go away from that mandate. So if, say, that unit trust, what they do is invest in real estate, that platform will be investing in real estate. You cannot start investing in real estate today and then move and start investing in bonds the next day. So there are already goals and objectives. If those goals and objectives are aligned to you, then you can use that unit trust. So from that facility, you get sort of like a rate of return. Let me just call it a rate of return, or interest from whatever it is that you have put in. So if that does well, so your success depends on how good this organization that you have decided to use the unit trust in is. So if they are good, then you're obviously going to get good returns. You need to have trust in that particular place where you're putting your money in. The other platform where you can put your money in are mutual trusts. So mutual trusts, they either invest in, say, fixed income, which is essentially bonds, or money market. Money market is more liquid. Is more liquid if you look at it closely as compared to, say, bonds. So there are some organizations out there that deal in money markets, that deal in fixed income, essentially mutual funds, whereby you can put your savings in there. It can be money that you're not using at a particular moment, and then that will make you gain some interest. One thing though with this particular platform is, at times, if say you need your money immediately, you might not be able to get it immediately, because remember, they need to remove it from whatever platform that they had can be say shares, or it can be bonds, etc. So the lead time for you to get that money might be a bit shorter. However, there's some facilities that actually do it a bit quicker, and that is one of their competitive advantage. So make sure that you do your research, you find out which organizations you can be using for such a platform. And if you do decide to invest in something like this, make sure that you're well versed with their interest rates. Make these people accountable for, like where you're putting your money. Ask all the important questions. What has been your performance to date? What are your assets under management? How have these performed? Why has the rate go down? What is your plan for the next year, given that we are recovering from COVID, or we are still going through COVID, etc. What are the things that you've put in place to cushion me as an investor? Those are the things that you should be asking these institutions. So make sure that you go to a very credible institution, because now you don't want a situation whereby you put your money in there and then your money goes. Another avenue that you can put your money in is actually in real estate. So real estate is not very liquid. It's not very liquid at all, because when you're putting your money in real estate, you've probably decided to buy an apartment, you've probably decided to buy a block of apartments or a block of offices, etc. So as you can see there, for you to get that money back, it might take a bit of time, because you'll need to sell that particular asset. So you need to assess your risk appetite. However, for some people, they use that real estate money when they are now in their old age, because now probably that's rental money that you can be using for your upkeep, etc. So make sure that you do a good analysis of the place where you're buying that real estate. Is it a place that has other developments around it? Is it a place whereby there's going to be a lot of people? Because now you don't want to buy in real estate at a place whereby it is so much in the outskirts, there's no life there, and potentially there's a possibility of no life there at all. So, and then also you need to make sure that you know why you're buying that real estate property for. Are you going to want to live in it at a certain point, or is it a place whereby you want a situation whereby you're just getting rental income from? So real estate is actually a good avenue for you to put your money in. Just one thing that I can say for real estate is a bit expensive. So that is one thing that you can think through. But the good thing is there's some funding that's available for that, and you can get into a mortgage, etc. That's probably something that we'll then talk about in depth in a bit later on. I'm going to end with the riskiest platform, riskiest vehicle where you can put your money. And this one is, let me not say for the financial swervy, but you need to understand what you're doing. So this is cryptocurrency. And personally, I have not tried it before, because that is really one topic that you really need to understand what is happening, and not just follow, just do that heading principle. In financial behavioral finance, there's something called heading, whereby you just follow the leads and you're just following there blindly, and yet you don't know what is really happening there. So make sure that your risk appetite for this is really, because this is risky. This is risky. Cryptocurrency is essentially a digital currency, and you'd find that this is something that has been in the market for a while now. So this is something that we actually all need to understand, so that if that is where the market is heading, then you need to be knowledgeable, and with time put some money in there, right? With time. So some people have already put their money in there and they're doing so well. Other people have put their money in there and then they've lost a lot. So you need to be very financial savvy for you to know that this is what you are doing. Know your risk appetite. I was listening to some platform whereby they were saying just put a small percentage of your investment portfolio, just a small one, like maybe say up to 5%, if 5% and below, so that at least if you lose that money, you're not losing all of it, right? What we mean by an investment portfolio is, like say what we've talked about, you have some money in the bank, you have some in mutual trusts, you have some in, so that's your investment portfolio. You have some in real estate, and with that you can do a calculation to see where most of your money is at. So with that, they're just saying just put like say less than 5%, and then you see whether it's going to work for you or not. Yeah, if you have any suggestions, I would really appreciate them in the comments below. We'll go a bit in depth with time with reference to all these things, so that we can better understand it and we can learn together. Thank you guys so much for your time. please make sure that you subscribe, tell a friend to tell a friend, share. Thank you so much for your time, guys. Make sure you take care of yourself and you also take care of your loved ones. Bye.